Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
Lionshare Bookkeeping believes the key to generating wealth is understanding where it comes from and where it needs to go. They provide bookkeeping and financial coaching exclusively to real estate investors, focusing on cash flow, strategy, and action. Go to lionsharebookkeeping.com/apartments to connect with them now. This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Chad Sutton. Thanks for being on the show, Chad.
Hey, Whitney, happy to be here. I'm glad we could finally do this.
Yeah, me too. Chad is a managing partner leading the acquisitions team of Quattro Capital. Am I saying that right, Chad? Quattro?
You are. Quattro Capital. That's
awesome. Right. An investment firm focused on residential multifamily real estate, such as apartment complexes, mobile home communities, and mixed-use commercial. Chad is a recovering engineer who spent most of his career in corporate America in space flight and aircraft before turning into a niche real estate investor. Chad, again, welcome to the show. Quickly give us a little more about your background, your focus right now in the real estate business and what you do at Quattro, and let's dive into your superpower.
Absolutely, Whitney. Thanks for having me here again. And I must, go ahead and debunk the joke real quick. If you go to our website, thequattroway.com, you will see that, yes, we are Cinco in terms of managing partners, but Quattro is what is around the founding pillars of our company. So I've heard that before, but wait, you're Cinco, right? So yeah, kind of how I got to today, Whitney, I mentioned I'm a recovering engineer. I played as a global supply chain executive just before leaving corporate America. And that transition has been recent. So I'm the youngest partner in Quattro Capital at 32. I left my corporate job about a year ago at this point during the middle of a pandemic, right? So you want to talk about having some cojones at that point. But yes, I spent about 10 years designing all things from military aircraft engines to commercial aircraft engines to I actually worked on the space shuttle and what you will now know as the Falcon 9 rocket that was sold to SpaceX from NASA. So that the early designs of that, I worked there as well. Really cool stuff, Whitney. I spent a lot of time, I guess from an engineer's
anyway.
From an engineer's perspective, it was a dream sandbox, man. I had a lot of fun. I got to do some, I actually had a job where it was my job I was running tests and I would shoot dead birds into aircraft engines just to make sure they could ingest them. It was pretty cool. But fast forward, I looked after it was a really grueling life. Okay. Designing new products, you're always being squeezed for funding and try to do things, quicker and cheaper. And so it's a very tough life. And I eventually realized, look, I'm just expensive labor. That's all I am, and as soon as the company is having trouble, I watched people who I thought were much better than me, get cut at a moment's notice. And that was their livelihood. They put their entire heart and soul into that. That just didn't resonate well with me. And Whitney, I also looked down and realized, this American dream that I've built, me and my wife and I are both doing well, grossing well over $250,000 a year. We're paying about 40% in income tax. We were what you call the dinks, double income, no kids at the time, right? And we had no deductions. We had every loan you could imagine, student loan, car loan, house loan, everything like that. And we just realized all we had been doing is buying a bigger treadmill, right? So fortunately, looking back, my family was invested in real estate. Now we're talking small single family assets, nothing wrong with that. It still works very well. But as the patriarch of our family passed away, that got me involved in real estate as well as my business partner and Aunt Kim, who is, the main asset management brain in our company. And I watched her, kind of as I learned on the sides, turn a business that had kind of gotten into decline in their older age. It was thriving many years before, but had gotten into decline as granddad got sick. I watched her turn that, into 140% of what profit it was in a year. So we're like, okay, this is how you create value in this country, right? So from there, we really, we banded together and decided, how do we get educated and learn to scale this thing? That resounding answer based on demographic trends in this country was multifamily assets at the time, and eventually will develop when that makes sense. And we formed Quattro Capital and have been acquiring first personally and then with private equity ever since.
Nice. Well, I appreciate you elaborating. It's just always interesting to hear how people find real estate, and especially leaving a corporate position like yourself, which most of us, I know I was, you're always trained, not always, but most are trained to think about, get the education, get the great job, right? And then you're just set, right? Then you get that retirement someday, right? Someday, you're going to have that retirement, right, Chad? And then you're not going to be that person like you're talking about that's let go many years in and devoted, it's horrible. I hate hearing stories like that, and people have devoted everything, their life to a corporation, and then all of a sudden it's just like they're a number, right? And they're like, go.
You are.
Yeah. I hate that. But I'm so thankful that just like you, we found real estate and got out of the corporate side, and now we're in control of so much more than we ever thought we could have been. So congratulations to you for making that leap, and now to where you're at now. Let's jump into what you do for Quattro. I know, you're in charge of acquisitions, and you do lead a lot there. Tell us a little more about your role within acquisitions, and let's dive into, just how you ensure you all are making just that sound investment.
Yeah. And that's really critical, guys. So, fortunately, being a recovering engineer, it means I have a lot of anal and nerdy tendencies, right? I'm very good with numbers, and I know how things go together. So I lead our acquisitions team in not only building relationships with our brokerages, and we actually look for direct to seller opportunities as well. But the real work begins when we start to, underwrite and discover, how is this property performing? How will it perform? We have to rely. I mean, underwriting is just a model. We have to rely on key data sources to make sure that we're actually pulling together a good model that is accurate as can be at this point. Everything is an educated guess. All models are wrong. Some models are useful, right? But, I also lead we typically contract out a lot of the due diligence work. We bring on, third-party vendors for everything that is specialized. And it's really a big project management and coordination effort to make sure that we are evaluating every possible risk and mitigating that risk with either cost input or verifying that it is in good shape as it is. If you miss a CapEx budget by 20%, that can really make or break your investment, right? So I spend most of my time leading a team of 3 that we have internally, as well as all of our property management and third-party vendors through that acquisitions phase, just vetting the property. And then from there, deal structuring is really the art of the deal, right? It's the art of the game. We have several loan products in our toolbox, right? And I'll tell you, every loan, guys, is it's a different tool in your tool bench, right? You have screwdrivers, you have hammers, you have saws. They all do different things. You can't just go to the same lender for everything. And so structuring the deal properly, making sure you're structuring the capital stack, the source of your money to, in the most efficient way possible. Like, for example, if you're going to go in and do a $1 million renovation, a heavy lift on a $3 million building, right? Assuming that works out on a pro forma, you're probably not going to go put a Fannie loan on that thing, right? Because you're going to be bringing, number one, it probably won't qualify, but you're also going to be bringing very expensive money from investors, right? You'd rather get as much of that money from the bank at 4%, than, or even at 6%, than pay an investor 20% for that $1 million, right? So that just juices everyone's returns and really optimizes the deal. So, not only is it, do we buy this, Whitney, it's how do you optimize it? How do you make sure that you're going to run that engine at peak performance, once it comes out? Because people think that everyone teaches the acquisition side. Everyone teaches underwriting. Everyone teaches, going and performing good due diligence. That's perfect. And it's all very important. But what I think people miss out on is teeing up the platform for the asset management team. And there's actually a lot of hand-holding in the beginning of transitioning that project to the next phase in the life cycle. And if that is set up wrong, the team's set up for failure, So I probably went a little too long on that, but
no, it's all right. It's great points. I just want to let you go there because that's some great things that all of us need to be aware of or think through, obviously, as we're buying deals and underwriting. You talked about evaluating every possible input. And I loved your saying too, just like all models are wrong, some are useful.
Yes.
That's I love that. But yeah, they're so useful, right? Some are more than others. But evaluating every possible input. Could you just elaborate on any other, inputs where you see people making mistakes, or where it's some of the first places that you go to check every time you're checking that model?
Sure. Yeah. So I break it into two different things, right? Well, three really. You have loans on the property, you have capital budget, and you have operating expenses, right? So those are really kind of the budgeting items where and CapEx is really just make sure you touch all the big ticket items, guys. If you're going to go, don't be scared of an old building, but understand it. If you're going to go buy an old building, know that there's high likelihood it may have asbestos, it may have cast iron drain pipes, it may have galvanized feed pipes, it may have aluminum wiring. Those are not bad things. Insurance companies don't like them. So you need to know how to mitigate if you need to. You need to budget for that. And like I'm buying a building right now. I was just talking to Whitney that we're about to rate lock this week. Everything's great on it. It's built in 1963. Solid brick construction. The roofs have been replaced. The electricals are copper. The feed piping is copper. So they've all been replaced at different points, but it still has the cast iron drain system. That's okay. You just have to budget to go in there and ream it out once or twice a year. And because it's rough, things stick to it, So understanding your construction, and don't be overwhelmed by that. Like Google can tell you a lot. Your experts can tell you a lot. And I'm going to try not to segue too much here. Don't think you have to know everything, right? The question is, who can help me understand this? Not how do I understand this, right? You will never be an expert at everything, but eventually you'll have talked to enough people that you can look at a building and know exactly how it's put together, right? So those are common pitfalls of making sure you don't miss those big ticket items. And, if you're off by $500 on a unit renovation, okay, so what? Put some margin on your budget. But if you miss a $274,000 flat roof replacement, that's a big deal. And I say that because that just popped up on one of our due diligence inspections, and that is a retrade, by the way. Hopefully this episode doesn't drop before the seller hears it. So anyway, so that's on the CapEx side. On the operating expense side, I think it's pretty simple to people miss taxes and insurance all the time. I like to break it into controllable expenses and non-controllable. Taxes and insurance are not controllable. The insurance world is wild right now. So make sure you understand and have something on paper showing what types of coverage you're going to get and what it's going to cost. And you better not miss a tax reassessment. I've seen people bring me deals before and they assume the taxes are going to stay flat and raise 1% per year. No, people are going to pick up on that. And I mean, it can be 2X in some cases, right? So you need a budget for it. The rest of it is really, look at what the local area is doing, rely heavily on the profit and loss statement of the property you're looking at, rely on your property management company, because, the rest of that is just kind of local knowledge. But I think the biggest area that people mess up, we're all taught to underwrite and dissect expenses and figure out what you're spending. But let's talk about income for a second, right? If you get income wrong, there's no going back. Expenses you can get wrong and figure it out. But, what I see people doing a lot of times in their early underwriting phase is they'll go say, oh, well, look, it's renting it at 700 today and market comps are 900. Great. I'm going to go underwrite 100 units at $900 in year one. I mean, think about what's wrong with that. You have 100 people probably who are signed on with leases that have varying exposure or varying expiration dates at around 700. You can't go in there day one and assume you're going to get 900 all across the board. So actually spacing that, I call it income realization, right? That there's a curve. It's if you lay out on a bar chart or something like, when do all my leases expire? And this is as simple as putting all your lease expiration dates in Excel and clicking graph. It's simple, right? Just see when they all spread out. And, you're going to see some properties are very even. Those are nice. And you can correct that if they're not, but some properties are going to have big exposure months where like half of them expire in July or something. Student housing is this way, right? So making sure that you're assuming your gross rent numbers based on when you can actually, take a unit offline, do whatever you need to do to it, lease it back up, and then the remainder of that year is your new rent, right? So give special attention to income realization, because I see people mess that up all the time. And it's very easy, especially the bigger the discrepancy, the bigger the error. Because if you go in there and say, hey, I'm $300 below market and I'm going to assume I get it day one. Well, guess what? You're going to be missing, 30% of your income in the first year that you thought you were going to have.
And probably a big portion of year two as well. So
exactly.
Great points there. I mean, you went through so many things from deal structuring to loans, capital budget, operating expenses, and also just the importance of knowing your income and when's that income like realistically going to happen. Right. Being conservative also about, how long is it going to take me to get this property to that point? I wanted to back up a little bit. You talk about deal structuring and, different, and you made a great point too, just different loans are different tools and you need to understand, how different loans work. And you talked about the capital stack. Any other tips on just the deal structuring? We hear that term a lot and, a lot of people think, well, wait a minute, how many ways can a deal be structured? Then I'm like, oh my goodness,
let me tell you.
I can't even tell you probably. I mean, there's so many different ways to figure these things out or try to make them work. However, that's also where some people can get in trouble too. But any tips on just thinking through the deal structuring, the capital stack, ways that you've been creative to still make deals work that maybe others couldn't?
So I'll say in the beginning, you're going to want to keep it simple, right? We started out with just a straight equity split. We didn't do a preferred return. It was just like, okay, 70-30. That's it, right? Everything is split 70-30 no matter what. Once you start to get into some larger deals and you start to try to acquire more stable assets in, let's say, a hot market like somewhere in North Carolina, right? You're going to see there's enough competition there that people are going to be creative with how to make that money work. So your typical 70-30 split or just underwriting for a 12 cash on cash year one or whatever people teach you, that's probably not going to work. But what you have to start thinking about, like really focus on the capital stack. And if we unpack that for a second, right? The capital stack, they can't see my hands, so I'm going to try to stop talking with them. But the capital stack, you start with the senior debt, right? So that is your loan. That's your Fannie Mae, Freddie Mac, bridge loan, whatever it is. You start with that. That's going to be your biggest investor. And yes, your loan is your investor. Okay. Treat them that way.
I like telling people it's like we're building a brick wall and that senior debt's on the bottom.
That is the foundation, right? So that's going to be your first brick and your biggest brick. And then if you have mezzanine or secondary financing or a second loan, that could be the next brick. So whoever's behind that in debt, so that's your debt 2 blocks. Above that, you're going to have preferred equity. Above that, you're going to have common equity. And then above that, you're going to have the deal sponsor, right? So, from bottom to top is priority of getting paid. If you don't pay your loan, you lose the property. If you don't pay your preferred equity, they get upset because they have right to that. So basically you as the sponsor are the last one to get paid. So what I see people doing, and we're actually starting to do this, let's say you're starting to play. So the 70-30 split thing can probably get you to about a $5 million deal. You probably can get some small ones in that area. You start looking at a 10, 15, $20 million deal. Let's just say you're looking at a $50 million deal. Let's say you need to bring, 10 million in equity for the bank. And then you're going to need maybe another, $5 million in closing costs and CapEx. Let's just say, for example, right? So that's 15 million you need to raise. You're probably not going to go get that from $50,000 investors. You can, but that's a lot of people. The efficient way to do it is to go work with an equity company or a high net worth individual or a family office or someone who can write a big check, right? Now, let me tell you what happens when they write big checks. They want a more secure position because they're in capital preservation mode. They're not looking for sexy 30% returns. Most of them, some of them are, but they're looking for, I want a good solid 10 pref on my money. And I want to make sure I get my money back first, right? If the deal goes sideways. So they will give you, they'll say, all I want is a 10% return on my money. And then I'll take a lower share of the residual upside. But, they want to make sure when you sell or when you refinance, they're going to get their money back first in front of everybody else. Well, that allows you to get, let's say, a $10 million check from one person that is cheaper than let's say a $200,000 investor who's in capital growth mode, right? He's looking to get the biggest return possible. Especially, that's your retirement investors. That's your medium to high net worth individuals who are, doctors, lawyers, people who have money and they're trying to grow it. Those guys expect 15 to 20% IRR, right? So if you start to structure it that way and you say, okay, well, let's do like two classes of investors. A class A investor is that preferred guy who's the big check, and he has kind of lower returns, but more preferential treatment. And then you have and I hate the term preferred, Whitney, because like no investor is more important than another. It's just about the waterfall, right? The buckets with which money flows. And then behind that, if you go get the rest of the money, let's say the 5 million from investors who are looking for a bigger return, well, guess what just happened? Now most of your money is cheaper, and the remaining money gets the residual upside that big investor didn't take, right? So now you can start to make a deal attractive at a higher purchase price and still make everybody happy with the returns. Because honestly, value in a deal, it is, how do I structure it to where I'm making everyone the amount of money they want to make and are happy with? And then how do I make sure I can sell it to the next guy? Like if you can make all those things work.
Quickly, because we're going to move on to a few final questions, unfortunately. But quickly tell us about working with that equity company. Who are they? How do you find them? Give us a couple tips there, because I know most people listening are trying to get to their first syndication. Maybe they've done a few. There's lots of very experienced operators as well. But most are probably not going to be as familiar with working with an equity company. What does that look like? How do you get to do that?
Yeah. And don't freak out, guys. You're not going to do this on your first deal, right? They're not going to come do this for you on your first, likely. But you start to do 2, 3, 4 deals, right, in the smaller space, and you start to get some attention, and organically people start to come to you. And this isn't really an equity company. It's kind of like a group of high net worth individuals, and they've hired an ex multifamily guy to invest for them. It's almost like an investment club, right? Well, one of our alliance partners had done a house flip. They fund single family flips. She had done a flip with them, and they got wind that she was doing a multifamily deal with us and got interested. So it was just like an organic relationship that happened. We initially brushed them off because it sounded like it wasn't going to be, a preferential or a good relationship. And then the more we talked to them about it, we're like, okay, you guys actually do know what you're doing in the space, and this makes sense for both of us. Let's talk about it. And what we've gotten out of this as we've worked together on the first thing, Whitney, is you always have to, perceptual positioning is key, guys. When you're talking to a property management company and you're trying to get them to take on a 20 unit building for you, don't just say it's just a 20 unit building. We did that. And we were like, hey, but we're going to go buy 6 others. Set the vision. So we set the vision with these guys that we want a 50% equity partner on every deal we do. You can be that partner, come in for 25% on this one. Let's get to know each other, but we want a big check writer, And so that it's a mutually beneficial relationship, because now they've got, places to park money. But what's it like working with them? You're going to have to expect that, for bringing big checks, they're going to have some special interest clauses, right? They're going to want to have some sort of a say or veto power on a sale or refinance. They want to kind of have not control in day to day usually, but you start talking to a family office and they're going to, I call them bad boy clauses, but it's more like, go sit in the corner with a cone on your head. So if someone's giving you $10 million, they don't want to be involved in it, but they're going to have something in there that says, hey, if you screw this up, I'm going to go put you in timeout while I fix it, because this is my money. Right. So you can expect,
and rightfully
so. So you can expect things like that. They're trusting you, but they have, it's yes, but this, so expect some of those type of things to come along, and expect that you need to have a good attorney, because these guys do, and they're going to run over you if you don't. So
yeah, they're going to end that transaction fast if you don't. So no, thanks for elaborating on that a little bit. It's not something we get to talk about a whole lot on the show. So I love hearing that and how people have done that. So maybe we can talk about it again sometime.
Yeah.
But quickly, what's been the hardest part for you, Chad, just getting into the syndication business and getting to the point you are now?
I think it was the mindset shift, Whitney. So when I started doing this, I was still in corporate America. I was working long hours at both, and you keep hearing me say, I, right? I was not leveraging other people properly. I was doing a lot of work. Right. And you start to figure out teamwork makes the dream work. Right. But getting over that mindset of, hey, I'm working and I need to get paid now, versus I'm working to learn and earning will come. Right. And I know that people can look and say, yeah, but I have these problems. Well, you know what? I had a lot of debt too. I had a lot of expenses. I had a kid. I had a wife. we restructured everything. Like this was not we got into this and all of a sudden bought a bunch of deals and lived happily ever after. It took us about a year to get enough trust to get our first deal. And, so there was a period where I was working and doing this, trying to get it off the ground. And, you just kind of have to divorce from that mindset that this is like a Rocky movie. And in 2 minutes, you're going to jump rope, for 10 minutes and go knock out the Russian, it just doesn't work that way. There's no fancy music in the background. It's a grind. It's hard, but you can get there, and you have to really work on your mindset to make sure that you are thinking positive thoughts. You can achieve this, and you kind of get creative along the way, right? So I think the biggest, it was mindset.
Yeah,
man.
Very true. So true. Mindset is so important. I would say listening to the Rocky music in the background might help keep you motivated, though.
It might. It doesn't hurt.
So, Chad, how do you prepare for a potential downturn?
So we've been through a few things in the pandemic already, and I love it because you learn the most when you go through hard times. Right now, we've prevailed on everything, but preparing for a potential downturn, at the end of the day, cash and cash flow are your lifebloods, right? So we go into every deal that we do. Sometimes with ones we do just with us, we don't, but every deal we do with investors, for sure, we go in with more cash than we need, and we make sure that we are, at least for the first 3 to 6 months, we're figuring out operations before we start to outlay a whole bunch of cash. You don't want to deplete your reserves so quickly. So it's very important to stay cash flush. It's very important to stress test your deals and know exactly like, okay, how big of an economic vacancy can I handle before I start to be negative cash flow? Now you're not distributing at that point, but first and foremost, your responsibility is to protect that business, right? And protecting that business means it's cash flowing, it's covering its obligations, and it has cash in the bank. So I won't really put a number on what that is, but it's different deal by deal, but you figure out what makes you comfortable, and what still makes the deal work, and you preserve capital, and then you just have to make the decision on, do I spend or do I hold,
What do you predict over the next 6 to 12 months to happen in the real estate market?
Yeah. So this is hard to outlay, but I do think we're going to have a housing crash in the single family market. Now let me be very specific. That is homeowners. Okay. As debt remains low, sales comps continue to rise, people pay more and more for houses. There's a bit of a bubble, whether it bursts tremendously or deflates slightly, I'm not sure, but it will deflate. The markets go up and down. This is the fact of life. Get used to it. I also predict that multifamily cap rates will continue to compress for a very long time. I don't see, now they will probably have to slow off, but if you look at the curve between the cap rate and the 10-year treasury, the 10-year treasury plummeting gave the cap rate room to start to continue going down and still getting a good spread between, what you're paying for an income stream and what you can lend on it, right? It's called the yield spread. So when you look at that environment and you look at, the environment that our supply and demand imbalance is going to be there for 20 plus years, like we're just not pulling enough permits to handle the renter nation that we're building, guys. I think multifamily is going to continue to be a strong investment. I think it's market by market. Of course, you're going to have to make sure you're in a good expansion market. But I do see that continuing to be a good investment for many years to come.
What are a couple of daily habits that you are disciplined about that have helped you achieve success?
Well, as you see, I'm dressed in workout clothes right now. So I'm doing a challenge with my team this year called 75 Hard from Andy Frisella. The guy's a little bit raw, so forgive me if you go listen to his podcast, but great guy, good motivator. It's about mental toughness. So yes, there's physical fitness and dieting and all that involved, but it's also about reading business books and documenting your progress and really doing those monotonous tasks every day that over time make you better, right? You don't see the result day to day, but you see it at the end of 75. So really working on my mental toughness is key because, this is not an easy game to be in, nor is anything in business. And having the mental toughness to know that you can figure out whatever comes your way is important. On the side of that, I also practice Miracle Morning by Hal Elrod, great book. So I rise, between 4:30 and 5:30 every morning, depending on how late I was up the night before. But typically getting in good high value work time before everyone else rises, it really sets your day up for success.
Could not agree more, especially about the Miracle Morning. That just changed my whole business trajectory when I got serious about the structure of my morning.
Businesses are built before 6 a.m. I'm going to tell you that right now.
I completely agree. What's your best source for meeting new investors?
Best source for meeting new investors? Honestly, I would say social media right now. And it's not that we're advertising or anything, but we have committed to posting value add content, posting personal things, being authentic, just being an influencer, right? And I can't tell you the number of that in podcasts, just being out there in the digital world. I can't tell you how many people are attracted to you by that, just by hearing you speak. They feel like they know you from watching you post, seeing your family, listening to me talk to you on a podcast, just that kind of organic relationship building. It starts that way. Then they reach out to you, and then you all of a sudden, have the opportunity to build a relationship. So I would say it's becoming very organic at this point.
What's the number one thing that's contributed to your success?
That's a tough one. I think I'll have to say, I was blessed by negative reinforcement with a work ethic as a kid. I was, not beat into submission, but, I responded well to a slap on the back of the head, but having that reinforcement to, make sure I knew how to work hard. I worked as a stable boy as a kid. Like I knew what hard work was at a very young age. I knew what I didn't want to do. And then, that fueled the fire for me to go do what I do want to do. And that what I do want to do has changed over time, and I'm sure it will keep changing. But having that fire lit in me early, I think has contributed to everything I've been able to achieve with my team.
How do you like to give back?
Philanthropy is one of our 4 pillars of Quattro. We love giving back. We give back in different ways. So, for example, when the explosion in Beirut happened earlier this year, one of our partners is a world traveler and has a lot of friends and family in Beirut. So we sent him over there with, I think it was 15,000 US and which is, a couple 100,000 US local currency, and put it in the hands of the people to help rebuild those businesses. Another one of our partners has built houses in Belize and places like that, just to kind of like these little self-sustain for 5,000 US, you can build a self-sustaining house with a chicken coop and all that kind of stuff. It's really neat. I personally love giving back through the church as monetarily, of course, but through music. I haven't done it in a while, but my favorite way to serve is actually to go and play music in worship and things of that sort, right? That's a really great way to get involved. So we all have our own ways of doing it, but, philanthropy is very important, and you need to give what you want to receive,
Well, I appreciate you sharing how you give and giving back in that way, and being so transparent about it. So important to us as well. So thank you for that. But Chad, great show. I appreciate you just sharing your time going, 32 years old, but moving from that great, quote, corporate position into, into a great business, and helping build that business and taking such a large role there on the acquisition side, but going through the deal structure and just those 3 things you talked about, loans, capital budget, operating expenses, and income, and numerous things. They're not just 3. Even just keeping it simple, in the beginning, and thinking through some of those things, it can seem so overwhelming, right, when you're first getting started. But I love how you even ended, just with how important mindset is, and some things you've done and are doing, just to keep honing your mindset, right? And it's so important. It doesn't stop. Right. I mean, it's something you have to stay into.
It's a muscle. It's a muscle.
That's right.
Yeah.
But grateful for your time and just, sharing some light or insight into your business and how you've been successful. So tell the listeners though how they can get in touch with you and learn more about you.
Yeah, the easiest way, and I'm sure you can put this in the show notes, Whitney, is to go to our website at thequattroway.com. Quattro is Quattro, and we'll see if he edits that out, if he puts it in the show notes. But that would be the easiest way. You can click on any of our pictures and schedule a time. You can follow us on social media. You can email us directly. So that would be the easiest way to reach out. And I think we even have some videos of personal introductions, so you can kind of get to know a little bit more about us on the site.
Thank you for listening to the Real Estate Syndication Show, brought to you by Lifeblood Capital. Lifeblood Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. Lifeblood Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.